Welcome, Stock Explorers, to the deep dive. Today we're digging into a company that's definitely causing some chatter, maybe even some arguments among investors. Inseego Corp, ticker INSG.
That's right. Inseego is, well, it's a really complex story, quite polarized, actually. Our goal today is to unpack why. It's this great turnaround, ready to ride the 5G wave.
Or is it maybe too risky, burdened by, let's say, a history of promises that didn't quite pan out?
Exactly. We want to help you figure out how to weigh all of that.
Okay, so what are we going to cover for you? We'll start with its recent preliminary nod for the Russell 2000 index. Then we'll dissect their 5G fixed wireless access tech FWA.
Yep, FWA. And after that, we'll look at the financials, the numbers, the targets from the new leadership. Ambitious targets, we should say.
Right. And finally, we'll talk about the key things, the critical factors that could shape its future if you're thinking about investing. So let's kick off with what's put Inseego in the spotlight right now. This preliminary selection for the Russell 2000, announced late May, effective end of June 2025. For a smaller company, why is this such a big deal?
Well, the immediate impact is this technical tailwind it gets.
Yeah.
The Russell 2000, it's a major benchmark for U.S. small caps, right?
Right.
And billions of dollars in index funds track it. They have to replicate its holdings. So getting included means these funds must buy Inseego shares.
So it's forced buying, essentially, like automatic demand.
Pretty much. It
Yeah.
creates this period of non-discretionary buying. It can be a real boost, even if it's, temporary.
So it's not just getting bigger on paper, it's actually getting seen by a whole different group of investors.
Absolutely. Big time. It boosts their visibility hugely, puts them on the radar for a much wider pool of institutional money.
Yeah.
And beyond that, it helps liquidity. It's easier to trade the stock. Management called it a meaningful validation of their financial turnaround. And, they're not wrong. Think of it like getting a window, maybe a short free pass, to prove their story to a bigger audience.
Like a stamp of approval, but it doesn't fix underlying problems, right?
Yeah,
It just gets them a seat at the table.
Precisely. It helps the stock price in the short term, creates some positive sentiment. But yeah, long-term value, that's still all about fundamental performance.
Yeah.
Execution.
Right.
In fact, it probably brings more scrutiny, too, from these bigger, more sophisticated investors who are now watching very closely.
Okay, let's shift gears. Let's dig into what Inseego actually does. They're known as a leader in 5G fixed wireless access tech. Can you break that down for us? What's FWA and what are their main products?
Sure. So FWA, fixed wireless access, it basically uses cellular networks like 5G to deliver internet to homes and businesses instead of, running a cable.
Okay, wireless internet for buildings.
Yeah, essentially. And Inseego's big on their Wavemaker series. Recently, they launched 2 new devices just for T-Mobile for business, the FX4100 router and the X700 mesh Wi-Fi thing.
And who are those for?
They're aimed at delivering secure, fast connections for small to medium businesses, retail spots, branch offices, often places that maybe don't have a dedicated IT team on site.
So it sounds like it's more than just the box itself. Like it's a whole system.
That's their angle, yeah. Their key differentiator. They call it a solution stack. It's not just the hardware device. It includes their own proprietary operating system on the router edge, plus their cloud management platform, Inseego Connect.
Okay.
Think of it maybe like Apple, but for business networking. A smooth, secure system that simplifies things, especially for smaller businesses setting up complex networks.
Got it. And technically, what makes their stuff stand out? Any cutting-edge features?
Well, the FX4100, for instance, has uplink carrier aggregation. That's kind of a big deal because it means much faster upload speeds.
Which matters for business stuff, right? Video calls, cloud backups.
Yeah.
Exactly. Huge data syncs, things like that. And their tech edge comes a lot from a really deep partnership with Qualcomm. They use their latest platforms. They even did an industry-first live data call on a new router, the FX5000, using the absolute latest 3GPP Release 18 standard.
Wow. Okay. So they're right on the edge of the tech curve.
They're trying to be, leveraging the newest wireless standards to stay ahead, keep things future-proof.
And it sounds like they aren't trying to sell to everyone. They're picking specific spots, high-value niches, like public safety.
Absolutely. That's a key one. 4 of their products, including the MiFi XPRO, are Verizon Frontline verified.
What does that mean exactly?
It's more than just a tech check. It means the devices can handle critical stuff like network priority, preemption things first responders absolutely need in emergencies, life-critical functions.
Okay.
Plus, they meet tough federal security standards, FIPS S142, TAA compliance. That opens doors for government contracts where security and reliability are non-negotiable.
Makes sense. And they also target secure enterprise, SMBs, and even bridging the digital divide, like working with C-Spire to get high-speed internet into rural areas, enabling things like remote learning, telemedicine.
Right. But that brings up the competition. How does a company like Inseego go up against, say, Ericsson? Ericsson owns Cradlepoint, right? That's a direct competitor.
Yeah, it's a huge challenge. They're definitely up against giants. But Inseego's management, they're not trying to win on sheer scale or being the cheapest.
Okay.
Their strategy seems to be about dominating these specific high-value niches where their strengths that advanced security, the reliability, the remote management really matter more than just price. The enterprise market often prioritizes those features.
And is that where the Cradlepoint playbook idea comes in? I saw George Mulhern, who used to run Cradlepoint, joined Inseego's board. That feels deliberate.
Oh, extremely strategic.
Yeah.
Mulhern basically built Cradlepoint into a leader before Ericsson bought them for, what, $1.1 billion?
Wow.
So putting him on the board sends a really strong signal. They want to bring those successful enterprise strategies over to Inseego. The CEO, Sarvikas, even said Mulhern's experience is going to be invaluable as they try to become more of an enterprise solution provider.
So they're serious about taking on the big guys in those specific areas.
Looks like it. It's a clear message to the market.
Now, you mentioned partnerships earlier. T-Mobile, Verizon, Qualcomm. That sounds great, but does relying on them create risks too?
It definitely does. It's both a huge strength and a potential weakness. These partnerships give them massive sales channels, no doubt.
Like the exclusive T-Mobile products, the Partner Plus program.
Exactly. Reduces costs for customers. And the Verizon link is crucial for public safety. Qualcomm is key for their tech innovation.
Right.
But relying so heavily on just a few big carriers creates customer concentration risk. It's a classic double-edged sword.
Meaning their revenue can swing wildly based on what those few partners decide to do.
Precisely. Inventory decisions, promotional cycles at T-Mobile or Verizon, it can dramatically impact Inseego's numbers. We actually saw that in Q1 2025.
Ah, right. The revenue dip.
Yeah, management pointed directly to delayed carrier and mobile broadband promotions and FWA orders. Shows how dependent they are.
Okay, so we've covered the market buzz, the tech, but the big question for any turnaround, can they actually make money consistently? Let's talk financials. They've had a pretty dramatic balance sheet cleanup, haven't they?
They really have. The last, say, 12 to 18 months have seen a major overhaul. They went from a pretty precarious financial spot to having much more stability.
How'd they manage that?
Well, they slashed their total debt by about 75%. That's over $100 million paid down from a peak of around $170 million.
Wow. Where did the money come from?
A big chunk came from selling off their non-core telematics business. That brought in about $52.7 million in cash.
So ditching an unrelated part to focus and pay down debt? Smart.
Yeah, it seemed like a good move. That cash, plus some other financial maneuvering, let them completely pay off all their near-term convertible notes by May 2025.
So what debt is left?
Now, all that's really outstanding is about $40.9 million in senior secured notes, and those don't mature until 2029.
That gives them breathing room.
Exactly. A much cleaner balance sheet gives the new leadership that crucial operational runway and, strategic flexibility. It was kind of like phase one of the turnaround, stabilizing the foundation.
Okay, sounds like a massive improvement on the debt front. But then you look at Q1 2025 earnings, and it's a bit confusing. Revenue down, but profitability up. How does that work?
Yeah, that's where things get interesting and maybe a bit puzzling for investors. Q1 revenue dropped almost 30% year over year. Missed estimates.
Not great.
No, but they posted their 9th straight quarter of positive adjusted EBITDA. That was $3.7 million.
Yeah.
From the year before. And their gross margin hit a record 47.3%.
So profits up, margins at record highs, but sales falling. What's the explanation?
It wasn't just luck. Management said it was down to a favorable revenue mix and keeping a tight lid on costs.
Favorable mix, meaning?
Meaning a higher percentage of their sales came from their services and other category, which actually grew nearly 50% year over year and carries better margins.
Ah, okay, so higher profit stuff made up more of the smaller pie.
Exactly. While the overall revenue weakness was, again, blamed on those delayed carrier orders we talked about, it shows they can manage for profit even when sales shrink. But
the market wants growth.
Right. Now the question is, can they apply that same discipline to actually growing the top line again?
Which brings us to this stellar second half challenge. Sounds like management has set a pretty high bar for themselves with their full year guidance. They're aiming for year-over-year revenue growth for 2025.
It's incredibly ambitious. Honestly, it's a really high-stakes test for them. To hit that goal after a weak Q1 and what looks like a so-so Q2,
How much do they need?
well, based on Q1 results and the Q2 guidance midpoint, they need to pull in over $121 million in revenue in just the second half. That averages out to more than $60 million per quarter.
Wow, that's a huge jump from where they are now.
It's a dramatic acceleration needed from their first half run rate, yeah.
So what happens if they hit it? Or miss?
Well, if they nail it or even beat it, that would be massive validation for the new strategy. Could definitely trigger a significant stock re-rating. It would prove they can deliver on the growth story.
And if they miss?
A miss would really hurt management's credibility. Badly. It would just feed that narrative that they overpromise. This stellar second half target is absolutely critical, not just for the numbers, but for the whole investment thesis.
Okay, this really puts the spotlight on leadership, especially the new CEO, Juho Sarvikas, who came on board in January 2025. What's his story? What's the plan?
Sarvikas has a pretty strong background. He was president of Qualcomm North America, and before that, chief product officer at HMD Global. He was key in relaunching the Nokia phone brand successfully.
So he knows hardware, products, getting things to market.
Deeply rooted in all of that, yeah. Hardware, go-to-market, supply chain.
Huh.
He's laid out 3 clear priorities. Qualify execution with the big carriers, boosting software and services revenue, and fixing the supply chain for better efficiency and cost.
And he bought stock himself.
He did. Picked up 10,000 shares at $9.78 back in March. That's usually seen as a positive sign, skin in the game, shows some personal conviction.
Definitely a vote of confidence. But I keep hearing this term, Inseego 2.0. Is that a sign of a fresh start, or does it maybe trigger some, strategy fatigue for people who followed the stock?
That's a really sharp point. That Inseego 2.0 branding, it's actually not new. A previous leadership team announced that way back in January 2018.
Oh, really?
Yeah. So even though the current team isn't really pushing that specific phrase, the fact that it lingers in discussions, it suggests maybe a perception that this is just another iteration, not something completely new.
Right. So long-term investors might be thinking, haven't we heard this turnaround story before?
Exactly. It can definitely create skepticism, that strategy fatigue you mentioned. It sort of undermines the message of a truly fresh start. Past struggles kind of cast a shadow on the current, potentially positive changes.
Which probably explains why, despite the board changes and the CEO's plans, the market still seems to be in show-me mode. Why is there still this credibility gap?
It really boils down to a history of, let's say, optimistic projections that didn't always pan out. Remember, after a strong Q4 last year, management then gave a pretty disappointing Q1 outlook, blamed inventory, promotions ending.
Right.
And analysts immediately called the full year 2025 targets ambitious, aggressive. The market feels like it's heard big promises before without seeing the follow-through.
Like they're waiting for that big contract win or something.
Yeah, there was maybe anticipation of some big deal drop, a single transformative contract. That just hasn't happened. So the stock has kind of languished, even with some positive operational news. That skepticism is deep-seated. Until the top-line growth really starts matching the rhetoric, that gap's likely to stick around.
Makes sense. Okay, every investment carries risk. What are the big ones investors need to keep front and center with Inseego?
Well, the biggest, most uncertain one right now is probably the potential for a huge U.S. tariff, maybe 32% on goods made in Taiwan.
And Taiwan is where Inseego makes most of its stuff.
It's their primary production location, yeah.
Yeah.
So this threat, it's totally unquantified right now, creates massive headline risk. It makes forecasting valuation really cloudy.
Has management said how they'd handle that?
They explicitly said their Q2 guidance doesn't factor in any potential impact. And they haven't publicly laid out a specific mitigation plan yet. So that's a huge question mark, a critical thing to watch.
Wow, yeah, that's a major external wildcard. What about risks more inside the company's control?
Well, the absolute central risk is just execution, plain and simple. Can this new team actually deliver that aggressive second-half revenue growth? Failure there would be devastating for credibility.
Okay.
Then there's still that customer concentration risk we talked about, relying too heavily on a few big carriers. That creates volatility. And of course, competitive risk is always there. Intense pressure from bigger players, like Ericsson's Cradlepoint, who have more resources.
So if you're watching Inseego, what are the key things to monitor in the next few quarters? What really matters?
Number 1, tangible proof of sustained top-line revenue growth. Upcoming earnings reports need to show that growth accelerating. That's the ultimate validation for the turnaround.
Just got to see the sales numbers go up.
Yep. And number 2, you need clarity on their strategy for dealing with those potential Taiwan tariffs. Without a clear plan, that uncertainty is just going to hang over the stock.
Okay, so let's try to wrap this up. To recap our deep dive on Inseego Corp, the company has definitely pulled itself back from a tough financial spot. The balance sheet looks much healthier.
Much healthier, yeah. De-risked significantly. And they do have a strong technology position in 5G FWA.
Right.
Plus, now they've got this technical boost from the Russell 2000 preliminary inclusion.
Right.
But the path to sustained profitable growth still looks pretty challenging. And the market, well, it's clearly skeptical. You see that in the Show Me story, the focus on those really ambitious second-half targets.
So this is really one of those high-risk, potentially high-reward situations. There's definitely upside potential here, but also some pretty significant hurdles to clear.
Absolutely. As an investor, hopefully you now have a clearer view of both sides, the promise of the tech and the leadership, but also the big challenges, especially around execution and those, unpredictable external risks like tariffs.
As we finish up, here's something to chew on. How do you personally weigh that promise, the cutting-edge tech, the cleaned-up balance sheet against the challenge of proving credibility and navigating those big geopolitical unknowns? What specific proof would convince you that Inseego is really finally turning the corner?
That's the key question investors need to ask themselves.
If you found this deep dive helpful, please do subscribe to the deep dive. Give us a like, maybe hit that notification bell so you don't miss our next analysis. We're here trying to help you make sense of this market.